Thanks for joining us. I'm Marlon Bowling with you as we watch your ag commodity markets here on a Tuesday that feels like a Monday. It's going to be a very short trading week, only 4 days long this time around. And on the phone with us, we have Brian Hoops. He is the president of Midwest Market Solutions. He's based in Springfield, Missouri, and he joins us right now as we take a look at some new information. We just got our new export inspections numbers, Brian, and I'm kind of looking over these numbers here, and we can share these with our audience. We had corn coming in at 355,411 tons that were shipped out of the country this past week. And it looks like we had sorghum at 88,474. Meanwhile, on the soybeans, we had 1.28 million tons. That was a fairly healthy number there. That was up from the previous week. That corn, by the way, was only about half what we had the week before. And then you had wheat coming in at 526,000 tons. Last week was 504,000. So they continue to ratchet up the wheat movement here overseas. Even the shipments are picking up a little bit. Do these numbers really mean anything to the trade right now?
Well, it's a very strong soybean number. That equates to 47 million bushels, and that's a really good number and what the trade really needed to see. And you can see the soybean market coming off of its lows to nearly unchanged after this report has come out. The corn number is certainly a disappointment. We're seeing corn falling to contract lows, a few sell stops being ran at this time, the wheat market at contract lows as well. And the wheat number, that inspections number at 19 million bushels, that's not a bad number for wheat. It's about in line with what we need to be doing to hit the USDA forecast. So, it would indicate that the USDA is pretty accurate as far as where they're at on wheat exports at this time of the year. Probably don't need to make any adjustments in next week's supply and demand report. But the wheat market falling to fresh contract lows, namely with Kansas City under heavy deliveries, it should spur a little bit additional demand as we're trading well below that $4 mark for December Kansas City wheat now.
While the soybeans have come off of their earlier lows this morning, the corn is kind of falling off the edge of the wall here. Let's take a look at corn and get everyone updated on prices. Right now, December corn down 6 3/4 at 363. We are now 7 cents off our overnight high. On that soybean trade that I was talking about, and we have soybeans kind of holding their own today. We have November now back to only 1/4 cent lower at 868 3/4, almost on the high of the day. It's just only one tick away. And now it did make a new high at 869 1/4. It flipped, and now it's 1/4 cent higher. January up 3/4 cent. So we're off of our low now by a dime in the soybeans. And then on the wheat, we have Chicago wheat on December down 8 1/4 at 454 1/4. And Kansas City, we have the December contract down 10 3/4 at 386 1/2. Now, what's going on? Is wheat following the corn? Is corn following the wheat? What happened today?
Well, yeah, I think the wheat is kind of leading things lower. The big deliveries are certainly weighing on the market in here, and that's dragging the corn market lower. Should mention, too, in that inspections number, out of that soybeans, which was 47 million, about 29 million bushels was shipped to China. And that's kind of got the trade's attention here and why we're rallying soybeans as much. So it's a pretty impressive shipment pace right at the end of the marketing year for China. They had a lot of sales on their books that they had not yet shipped, and we're finally seeing those shipments. And really that's the only positive that we've seen here so far in the trade with the contract lows in wheat and corn being scored this morning.
And it looks like the corn on December is at new contract lows. We'll check into that, and we'll come back in a moment, and we'll take a look at our livestock trade as well. We're joined by Brian Hoops. He is with Midwest Market Solutions. He is in Springfield, Missouri, and he joins us right now as we turn our attention now to the livestock side. And Brian, after we had that shakeout in the corn market just moments ago, and we were talking right before the break, we are indeed making new contract lows in that December corn today. Is that supporting the livestock trade? Let's take a look and see if it is or not. On the live cattle, let's jump over there. And currently on the live cattle board in Chicago, October cattle up 25 cents. We're at 99.17, still a $0.50 away from our earlier high of the day. December up 55 at 104.22. And let's look at the feeder cattle market. Sometimes feeders are more sensitive to the corn market. Well, they are reacting. We have September feeders now up $1.60 at 134 even per hundred, and October up $1.17 at 131.97 per hundredweight. That is now about $1.25 off our earlier low this morning. Meanwhile, in the lean hog market today, We now have October up $2.25 at 65.78. There they go. We have December up $1.20 at 64.58. So is this partly the sharply lower corn market that's supporting the livestock trade today?
Yeah, especially in the feeder cattle market, we're seeing some buying interest come into there with corn hitting those contract lows. Demand for feeder cattle should improve a little bit. We're seeing some speculative buying come into this cattle market as well. It was a very volatile session on Friday with contract lows scored in the December contract. So we are seeing a little bit of buying come into the market, maybe some bottom picking, and hoping that this cash trade is going to be firmer this week. We lost a couple dollars last week. October is holding a big discount to where the cash actually traded of about $4. So we may narrow that up here in the weeks to come. We should narrow things up with a combination of futures rallying to meet the cash market. So we would look for the feeder cattle to be a pretty strong upside leader here with cheaper corn prices. The hog market also feels like it wants to try and rally, and we're seeing a pretty sizable rally led by the front month contracts.
Speaking of the hogs, that nearby October lean hog contract is still at about a $23 discount to the June of next year, but they are narrowing up somewhat today. Is that historically wide, do you think?
It's historically kind of wide, yes. Yeah, we've got June almost into the $90 range, and October reflecting more of what the cash market's going to be today versus where we could see it maybe by next summer. But, those summer month hogs may not rally a whole lot more until we see more about our demand prospects, maybe an agreement with some of these countries to buy our pork products. And that should give October a chance to gain against that summer contract, as you mentioned.
Okay, well, thank you, Brian, for talking with us. Brian Hoops of Midwest Market Solutions in Springfield, Missouri. So, Jenna, that's the latest action. Kind of jumpy markets now.
All right, thanks for the update as always, Marlon.